Have you ever wondered what is money really, and who gets to make it? It's a fascinating question, and one that the economist Hyman Minsky spent a lot of time thinking about. This is the story according to MMT co-originator Wray. Minsky held the view that the money supply is endogenous, or determined within the economy itself, rather than by external factors or central bank policies alone. This is a significant departure from the traditional understanding of money and its creation. He also believed that anyone can create money. The challenge is in getting it accepted. This is where the social and economic processes come into play. Other individuals or entities must recognize the financial instruments you've created as valid for them to function as money. In Minsky's view, money is primarily a unit of account. It's the standard numerical monetary unit of measurement of the market value or cost of goods, services, and assets. Minsky also saw banks as innovative profit seekers. He believed that banks do not first gather deposits and then lend them out. Instead, they create money through lending. In other words, when banks lend, they issue IOUs, or deposits. The central bank plays a crucial role in this process. It supervises and regulates banks in setting interest rate targets, but banks will inevitably try to find ways around these rules, requiring constant regulatory adaptation. Banks make loans and subsequently find reserves to cover cash withdrawals. The supply of reserve money is not determined by outside factors, but rather by the needs of the banking system, with central banks accommodating the demand for reserves. For a bank's liabilities, such as IOUs, to function, they must be generally accepted. Achieving this acceptance is the real challenge. Banks create money by lending their IOUs. This means that extending loans creates deposits. Banks are not intermediaries. They are creators of liquidity. They turn less liquid assets into more liquid liabilities. This process of liquidity creation is highly endogenous. Liquidity is readily created in good times and can potentially vanish in bad times. The only entity that can ensure liquidity during crises is the central bank. Bank credit can amplify economic cycles, accelerating booms and exacerbating crashes. This is central to Minsky's financial instability hypothesis. In essence, Minsky's views on money and its creation provide a fresh and insightful perspective on the dynamics of our financial system. It shows us that money is not just a static entity, but an active participant in the economic processes that shape our world.